Liquidity risk. Why it's crucial for banks to manage. Liquidity risk is a critical aspect of banking that often doesn't get the attention it deserves. But understanding and managing this risk can make the difference between a thriving bank and a financial disaster. What is liquidity risk? Liquidity risk refers to the risk that a bank will not be able to meet its short-term financial obligations due to an imbalance between its liquid assets and liabilities. In simple terms, it means not having enough cash or easily sellable assets on hand to comply with demands from depositors and creditors. Importance of managing liquidity risk. Customer confidence. Maintaining adequate liquidity is fundamental to preserving customer confidence. If a bank is unable to honor withdrawal requests, it could lead to a loss of consumer trust, something that can take years to rebuild. A sudden bank run can quickly spiral out of control, impacting not only the bank, but the entire financial system. Regulatory compliance. Banks are required by regulators to meet specific liquidity ratios. These requirements ensure banks can handle economic downturns or unexpected demands for cash. Failing to maintain these ratios can lead to regulatory penalties and increased scrutiny from oversight bodies, further complicating a bank's operational health. Market stability. When banks manage liquidity risk effectively, they contribute to overall market stability. A bank that has sufficient liquidity can weather economic storms without contributing to systemic risk, a scenario where the failure of one bank could impact others, leading to widespread financial distress. Managing liquidity risk. Key strategies. Liquidity Coverage Ratio, LCR. This regulatory standard requires banks to maintain a certain level of high-quality liquid assets, HQLA, that can be quickly converted into cash. By calculating and complying with the LCR, banks can ensure they have enough liquidity to cover net cash outflows for a 30-day stressed period. Stress testing. Regular stress testing allows banks to simulate various economic scenarios and their potential impact on liquidity. By understanding how different situations like a sudden spike in withdrawals or an economic recession would affect their liquidity, banks can develop contingency plans to mitigate risks. Diversification of funding sources. Relying on a single source for funding can expose banks to liquidity shortages. Diversifying funding sources by incorporating deposits, wholesale funding, and interbank loans creates a more resilient liquidity position. This makes it easier to respond to withdrawals or unexpected cash flow needs. Effective cash management. Banks should actively manage their cash flows by prioritizing liquidity in their investment strategies. Allocating a portion of assets towards liquid investments ensures that cash is readily available when needed. Contingency funding plans. A contingency funding plan outlines strategies for addressing liquidity shortfalls in times of crisis. Having access to lines of credit, maintaining relationships with other financial institutions, and creating a list of potential funding sources can help a bank navigate tough situations. Conclusion. Liquidity risk is a fundamental concern for banks that, when managed correctly, is crucial in maintaining customer trust, regulatory compliance, and overall market stability. Through effective strategies like adhering to the liquidity coverage ratio, conducting regular stress tests, diversifying funding sources, managing cash flows efficiently, and developing comprehensive contingency plans, banks can adept manage liquidity risk and ensure their long-term success. Understanding liquidity risk isn't just about survival, it's about thriving in a competitive and often unpredictable financial landscape. Ready to elevate your treasury expertise? Become a Global Banking Hub member to access exclusive courses, earn certificates, and get personalized feedback. Join now at www.globalbankinghub.com.